Hey there, everyone. Happy Wednesday, December 4th. Welcome to Chart This with Dave Keller. Happy to join you today after the close and talk about market action through the lens of technical analysis. We're coming to you live from a actually beautifully clear but quite frigid Redmond, Washington. Hope you are doing well and staying warm wherever you're watching this from. We are live streaming on Facebook, on LinkedIn, on YouTube, and on X. I appreciate so much you tuning in wherever you're at. If you're watching the replay on YouTube, I appreciate you as well. If you are watching it live, I can see comments that you're putting in on any of those platforms. Wherever there's a comment section, I can actually see it through the streaming platform. So put your questions in as we go through the market recap, as we talk about the heat map review, as we talk about individual charts and particular levels. And then at the end, I'll hopefully take a question or two before we wrap the live stream. We are planning an all mailbag segment at the end of the week, and we'd love to feature one of your questions there. So if you don't get to it, it will go in the mailbag. Kind of an interesting day, I would say, overall. If you're questioning whether this is a risk-on environment, the S&P continuing to just push higher probably should be one of those indicators you're most looking for, because as I was told many years ago by a long-term technical analyst, or a long-time technical analyst, rather, Paul Montgomery, editor of Universal Economics, the most bullish thing the market can do is go up. So the market doesn't care what we think should happen or will happen or might happen. It is all about the action itself. So let's focus on the message the markets are providing back to us in the form of price and volume and breadth and sentiment. Let's see what sort of signals we can uncover today. All right, looking at the S&P and the other major averages here in our market overview, we have the S&P 500 closing around 60.86, and that's up 0.6%, new all-time high for the S&P 500. The Nasdaq Composite moving even higher, about 1.3% to the upside, up above 19,700 for the first time. The NYSE index essentially flat, and if you look at the mid-cap and small-cap index, up, but not nearly as much as the S&P. So that theme, which has really been the story for the entirety of 2024, large over small, continues to be in play. The Nasdaq 100 up about 1.25%, and the VIX moving higher as well. And that is an important data point, and I'll tell you why. I just released the latest episode of our Market Misbehavior podcast. Had an opportunity to sit down with the author of this book, The VIX Trader's Handbook, written by Russell Rhodes. I was able to chat with Russell and just released that episode. It was a lot of fun. Talking about a great opportunity to sit down with someone who has spent, his career analyzing volatility, been there thinking and talking about the VIX for years, educating traders on the floors of the CBOE and other exchanges on how to think about volatility. And I got to ask him all sorts of things about the VIX. Watch that episode. Do yourself a favor, because toward the end, I asked him about what he might be looking for as we go into December, into January. And he said stocks and volatility increasing at the same time would be a big time warning sign based on his analysis of previous market tops. Not lost on me as I look at today in the S&P and the Nasdaq going up on increasing volatility. Now, keep in mind, the VIX is still relatively low. That's another thing that we talked about quite a bit, was the general range of the VIX, how to think about the levels, looking at the trend in volatility and so forth. So go watch that episode for sure. It's posted now on my YouTube channel. But for today, the VIX moving slightly higher, still fairly low. We are still in a low volatility environment. You can see bond prices basically opened lower and then traded higher through the entirety of the day. The TLT finished today just above 94, and that's up about 1.1% from yesterday's close. When bond prices move up, bond yields move down. And so you can see the 10-year yield finished around 4.18%. The long bond yields around 4.35%. The dollar index, essentially no change, kind of a choppy session, but the dollar, no real change from yesterday. The commodity ETF we tracked, the DBC, was down about 0.5%. That's mainly because of oil prices that went lower. The USO was down about 1.6% today. Gold and silver prices actually both moved higher. The GLD just below 245, and that's up 0.3%. Silver prices even better. Looking at cryptocurrencies, the Bitcoin one more time approaching 100,000. It actually teased 99K here over the last really during the equity trading session here over the last 6 hours or so. did not get much above 99,000, did not breach 100,000. That is still, a wait and see kind of period. I do own Bitcoin and Ethereum. I'm bullish on the long-term structure. In the short term, not surprised they are finding resistance at key big round numbers. Bitcoin 100K is an important level. I saw a post on X before we went live with the show saying this may be the last time Bitcoin ever touches 99K. I don't know about that one, but I would say that the trend overall is quite bullish if and when we can push above that big round number of 100K. For now, it's not happening yet. We'll continue to monitor those that chart for sure. Looking at the 11 S&P sectors, you can see it's back to FANG on top. Is what we talked about yesterday. It was the three, FANG sectors kind of up and everything else struggling, or maybe two or three of them up. Today, only 4 of the 11 S&P sectors were up, but it was some of the biggest ones. So technology up 1.8%. We're continuing to see upward surges from Nvidia, Apple, and other technology names, really continuing the uptrend that we've seen in the last week out of the technology space. Consumer discretionary number 2, up 0.9%, followed by industrials and communication services. So the 3 FANG sectors up for the day, and that's enough to make the major averages push to the upside. On the downside, energy, the big loser, and I'm not surprised by this. It's down 2.4%, as we've sort of reiterated, in my experience, energy is a play on crude oil, right? And energy stocks go up when crude oil prices are expected to go higher. Crude oil prices have been languishing. They've been a nothing burger. That's my professional technical analyst opinion. It has been not an impressive chart. It's been choppy and sideways at best. And as a result, the XLE is not doing particularly well, particularly on a relative basis, right? That's where the underwhelming performance in energy really gets you, because you're missing out on the opportunity to own other things that have been going up a lot more consistently. Materials down about 1%, and then financials, third from the bottom, down 0.4%. Continuing on here, let's look at the let's look at the breadth actually briefly. Earlier in the day, the breadth was a lot more negative. Yesterday, we highlighted the fact that the market moved higher, but the breadth conditions were a lot weaker. Earlier in the day, the breadth was actually a lot more skewed negative. It was decliners well outnumbering advancers. By the close, these numbers are basically even, right? I mean, they're essentially the same between stocks going up and stocks going down. So that's, the conditions improved through the course of the day as the early strength continued to build, and stocks that had been going down ended up finishing back in the green. So overall, I would say no real change in the breadth conditions. That's an important area to monitor. I would say right about now, we highlighted the Hindenburg omen, flashing its initial sell signal in the month of November. Now we need a confirmation. We need another sell signal reiterated. One of those components that you would need to see in the next couple of weeks would be the McClellan oscillator rotating back below 0. It's probably not going to happen when advancers decliners are this even, would be my guess. We'll have to see when the chart is updated, but for now, no confirmation signal to speak of. Let's look at the mega cap leadership names, what we call the Magnificent Seven and friends. You can see Nvidia at the top of the list, finishing the day up 3.5%. So, semiconductors have not been particularly impressive. Yesterday, we highlighted how most of the bottom 10 stocks, that is, or at least half of them were all semiconductor names yesterday. Nvidia has been actually a very positive outlier. It's been one of the Mag 7 names actually doing quite well. Today, sort of following through with that, 3.5% to the upside. Amazon, number 2, up 2.2%. Tesla and Alphabet both having decent up days as well. On the downside, or at least the worst performers, were still okay. Meta and Apple kind of stalling out. No real change from yesterday's close. Now, both of those names have seen significant breakouts here in the last week. And so the question is the sustainability of those advances. For the market to really move higher significantly in the month of December going into January, you need to have these names doing pretty well. And I would argue you need to have the Metas and Apples and others that are breaking to resistance and breaking through it, sustaining those advances and seeing additional gains above there. So for now, we're not really seeing enough of a follow through there, but overall, of course, those charts are still in really good shape. All right, let's look at the market carpet. This is a heat map visualization on the Stock Charts platform. I've always loved visualizations like this, and over the course of my career, I've experimented with a lot of different designs and different ways to think about it. I'm a fan of how Stock Charts has built this. this particular visualization. I'm probably biased by the fact that I had a lot of input on what this should look like. So not surprisingly, I'm a pretty big fan of it. But I would say overall, as we've mentioned many times, 3 ways you look at a heat map like this, at least in my opinion. Number one, look across the board. Sort of take a step back literally from your monitor and sort of what are your initial takeaways? What stands out to you, right? What sort of general themes are you seeing? That's number one. Number two, look at the biggest names that have the biggest impact. What are they telling us about the performance of those leading, those large names? And then finally, look for outliers. Look for things that look different. Look for things that stand out. Things that are a little, differentiated from other similar boxes right around them, and that can tell you maybe some interesting moves to be familiar with. So first, high level, I'm immediately drawn to the weakness in energy, which is almost all in the red. As we mentioned, oil prices down today. Most of the energy stocks in the S&P 500 were at best flat, and at worst, like Exxon and Chevron and Marathon and Halliburton and Devon Energy and Occidental and others were all in the red. Pretty big down day, 2 to 3% to the downside here. Energy remains, again, an area of the market I'm not super interested in exposure to. And the reason is because crude oil prices are not giving me any technical indication that that there's upside potential there. There could be. I'm just not seeing enough evidence to tell me that it's worth taking a shot now, because what you have to remember, I think, as an equity investor, it's all about the opportunity cost. We often think, analyze the chart of Chevron and decide whether or not we should buy or sell it. What I learned working for a large money manager is it's not about getting the analysis on an individual stock right. It's whether you're looking at the right chart in the first place, right? What you want to understand is if you put some of your capital in a particular stock, you're choosing to own that stock, but you're also choosing to not own tens of thousands of other stocks that you could use that money for. And so do I want to own energy and not own some of these technology names that are in clear uptrends that are showing strength and continuing to improve? I don't think that's a great decision at this particular moment. At some point, maybe we get some mean reversion and energy improves and technology lags. It's not happening today, folks. So overall, I would say the weakness in energy, the strength in technology are sort of the big takeaways that I would see on the high level review of the market carpet. Number two, looking at the biggest names, of course, Nvidia stands out. Amazon, Alphabet, Tesla, Microsoft, even Eli Lilly having some pretty big up days. And that's pretty encouraging. Third item, and I would also mention as we hit earlier, some of these stocks like Apple and Meta. Great charts, and I would say long term still quite good. But I'm very much noticing when they're not going higher when the benchmarks are right. They underperformed today. And so the bull case, I would say here for the S&P and the Nasdaq means those leading names need to break out and then continue. We want to see additional buying power, additional buyers willing to come in and push prices even further. That's how the major indexes go up further from what they've seen so far. So I still, I would say watching those charts would be pretty important. Finally, any sort of outliers. I'm immediately drawn personally over to the industrial sector. Alaska Airlines, which is the biggest carrier here in the Seattle area, making a new 52-week high today. You're seeing other breakouts from the other airlines, United, Delta, and others, Southwest, having some pretty good follow through. Now, airlines were a little noisy there in October and November, kind of chopped around a little bit, but pretty much all of these are reinitiating to the upside, and I would say those trends are pretty decent. So encouraging for airlines for sure. I would say in the consumer discretionary sector, and there are some earnings kind of coming out here, but I'm particularly noting breakouts in Chipotle, which is up about 5% today. I was going to say Borg Warner, but that's not yet. Bath and Body Works, another one kind of breaking out. BBWI is an interesting one because it's been in a downtrend for quite some time here. It made a major low in September, then consolidating and then starting to improve from there. I'll try to remember to bring up a chart of BBWI at the end. That's an interesting one to actually review. So that's how I would describe it. And then, of course, the strength in technology. I mean, a lot of these names obviously showing some renewed strength, particularly some of the semiconductor names, which have not been great, like a Micron having decent days. I would say those charts are still kind of rough. And I would say Microchip Technologies is still not a great chart, even though it's had a bit of a bounce off of a November low. I mean, these are charts in primary downtrends that are coming off of very beaten down levels. Compare that to something like a Palo Alto Networks, a PANW, which powered above $400 today. So I'm seeing strength and sustained strength in some of those areas of the market. And again, that's where I generally speaking want to put my bets. All right, before we get to the chart review and go through a little more detail, I do want to remind you, if this sort of analysis of charts, thinking about technical indicators, thinking about intermarket analysis and how to visualize market activity to improve your market awareness, if that is exciting to you, you should check out my free behavioral investing course. I challenge you to rethink the basic premises in your investment process. Think about what information you're consuming. Think about how you're making decisions. I'm not going to give you all the answers with this free investing course, but I'm going to make you think. And people coming out of that free 5-week course via email with a bunch of great videos and homework assigned every week have told me it just helped them to revisit some of the areas of their process that they knew were not great. And I just sort of gave them the catalyst to improve that. So I hope you will find that meaningful. You can go to marketmisbehavior.com/free course, or just scan the QR code shaped like a coffee mug that you see on your screen. I hope you'll check that out. I hope you will find it is time well spent. All right, looking at the daily chart of the S&P 500, I mean, obviously the most important thing to take away here is it's going up. As I mentioned, Paul Montgomery's one of my favorite quotes, because I often get, when the market goes up, I often get people telling me it's overvalued, it's overextended, and you're not wrong, right? Compared to historical valuations, yeah, we're kind of overvalued. Compared to historical frames of reference, yeah, the RSI is overbought, right? The RSI is over 70. So all of those are signs of a market that's gone up a lot. But if there's one thing I've learned in my history as a market participant, and if you look back to this chart over my right shoulder is a chart of the major averages going back. They generally speaking go higher, right? That is the reality of the equity markets since inception. If you go back hundreds of years, the equity markets generally go up. They have drawdowns, they have pullbacks, they have corrections. All of those things are true, but 100% of corrections have been completely erased by the market making new all-time highs. Eventually, sometimes it takes longer than others, like the 1970s, but it has 100% of the time retraced 100% of those corrections and gone on to further highs. So generally speaking, the most bullish thing the market can do is go up, and it is going up. That's defined by my market trend model. That's defined by just the simple analysis of, is the market making higher highs and higher lows? All of that's happening. Now, I would tell you that another big part of my toolkit is, once I've confirmed that the market is going up, which it is, that you then start to look for contrary evidence. You look for things like the Hindenburg Omen. You look for those leading indicators like divergences that would tell you, hey, the market's going up, that's great, but it's starting to change character a little bit. Maybe the volume's not as good as it was. Maybe there's less momentum. Maybe there's some distribution that we can see by looking at some volume statistics. Maybe the sentiment's getting too extreme. Those are the things that we'll focus on here as we have the market in a primary uptrend, because uptrends don't last forever. At some point they end and the market pulls back. And if we can try to anticipate those, I'm a fan. Now, where you are not seeing divergences right now is in terms of volume. And the Chaikin money flow is a chart that I highlighted here today, mainly because as the market has been going higher, it's been marked by stronger volume. And in the first half of November, we actually had the Chaikin money flow being relatively flat. And what that essentially means is that there's no real differentiation between up volume and down volume. Over time, over a couple of weeks, the volume was kind of even on the upside and the downside as interpreted by the indicator. Now the volume, the Chaikin money flow has been quite strong from mid-November through the holidays, and now into the first week in December, quite strong. The S&P is going up, the volume is solid, and it's continuing to go higher. At some point, that changes, and if you look to the left on the chart, we can see examples of where the market goes higher on weaker volume, where the indicator starts to slope downwards. We last saw that in October, which is why a pullback felt very expected and reasonable. It was not much of a pullback. We ended up having this island reversal as we gapped lower for about a week and then gapped right back up after the elections. I think the elections really changed. I think it surprised a lot of people in terms of the outcome. Certainly, I think the markets have been surprised to the upside with renewed optimism about conditions and how they may evolve in the new year. I'm happy watching the market go up until it doesn't. And one of the things I will look for is declining volume readings as the market goes up. For now, overall, it's a thumbs up. Important chart to follow, though. I mentioned my interview this week with Russell Rhodes. Again, I encourage you to check that out. It was a lot of fun. Some really good answers, I thought, to questions I asked about the VIX and how to think about volatility. For me, the key is to recognize when the volatility regime changes, meaning the volatility has a certain look and feel, and then it changes. We may have started to see that here because the VIX has been, after that big spike higher in August, and I actually did ask my guest about that particular spike. I'll let his answer sort of do the talking about how he interpreted that move. But since then, the VIX has been kind of between 15 and 20, 23 or so on the upside. Now, all of a sudden, the VIX is back in the low teens. The volatility looks a lot more like late 23, early 24. We're kind of back in that 12 to 14 range again. The VIX remaining below 15 or 16 is a low volatility environment with really no warning signs at all. So just like we would look for the Chaikin money flow to rotate lower, another warning sign would be a spike in volatility and recognizing if uncertainty increases. For now, the market, investors are essentially pretty confident in this market going higher. Speaking of things going higher, Bitcoin, now it has not broken above that ultimate ceiling of 100,000. I mean, where do we go from here? We can go higher, but we have to get through that level first, right? The key is trading up to a resistance level and then powering through that. We've seen that in the history of Bitcoin when we've approached big round numbers like 10,000 or 20,000 or 40,000. Now we are facing a big one, 100,000. I would expect that it gets above there and goes further, but for now, we're not seeing that. For now, it's sort of stabilizing. It's sort of in an equilibrium. It's consolidating. And now you wait to see the price break to the upside. I think breaking over 100,000 is sort of that signal that would confirm the next move higher. Where do we go from here? There are a series of technical tools we can use to try to project the next leg higher. A lot of the projections I used based on this period back here were sort of in the 96 to 100,000 level, and that's kind of where we're at. So if and when we would break out, I think you need to reevaluate, and we'll sort of develop those upside targets based on other measurement techniques. But for now, I would say wait and see mode. And when do we see, not if most likely, but when do we see the break above Bitcoin 100K? Let's look at some individual stocks here on the move and in the news. Nvidia, of course, is one of those magnificent 7 names, having a nice update. Top performer out of that group, up about 3.5%. For now, a lot of these big names had stalled out, right? Like Meta had resistance around 600, tested it a bunch of times. As we highlighted earlier this week, it finally has broken above 600. And the question is, does it sustain that breakout? We have a similar kind of pattern here with Nvidia on $150 a share. That's where we tested resistance in November a couple times, most recently in mid-November with this big sort of long day where we rotated lower. We found support around 132, which was the low from late October. So now we have a clear resistance level around 150. We have clear support around 132. John Bollinger, in a conversation years ago, told me, look, before a big break in either direction, you tend to have a lower volatility. You tend to have the Bollinger Bands narrow, which represents a lessening of volatility. And the big moves tend to happen after a quiet period. It's kind of the calm before the storm. So what I like to do in this sort of environment is set alerts. Set an alert for NVIDIA below 132. That's your sell signal. Set an alert for NVIDIA above 150. That's your buy signal, generally speaking, right? That tells you the price is breaking down and or the price is breaking up. And until and unless you see those signals triggered, NVIDIA is basically telling you to wait, right? And as Jesse Livermore famous said, there's time to go long, time to go short, and time to go fishing. This is the kind of pattern for me. It's a fishing pattern, right? We wait for the break, which tells us whether we want to be long or short after, seeing how we resolve out of that consolidation pattern. I think part of my goal here in 2024 is just to remind us that charts that have been going up can continue to go up. I remember being asked about ServiceNow a number of times through the course of the second half of 2024. Basically, the question was, did I miss it? Did I miss it? How about now? Did I miss it? Did I miss it? And every time my answer would be no, not necessarily, right? Just because the price is breaking out is not a bad thing. We would always say back in the day, never confuse the top of the page with resistance. Just because the price is making a new high, I think we automatically start to get nervous, like, oh, I missed the move. I wish I would have bought back here. But one of the things I've learned working with a lot of growth-oriented investors, there's plenty of money to be made buying breakouts and playing that entire trend sort of pushing higher. Investors have made careers out of looking for that particular pattern. And so even in this environment where it has felt like markets are, arguably overvalued for much of 2024, as long as the price keeps going up, we're in good shape. And so ServiceNow and Palo Alto Networks and other technology names in primary uptrends, I assume those charts are going to keep going up and keep making higher highs and higher lows until the chart tells me otherwise. The chart is not telling me otherwise just yet. Salesforce.com, one of the earnings names, they reported yesterday. Nice upside today, gapping higher, about 11% to the upside. This is coming after, what I'd probably call a pennant pattern or a coil pattern. We've had a big run higher, and then the short-term consolidation of lower highs and higher lows. Again, similar to the pattern we talked about with Nvidia. When you have a consolidation pattern, you wait to see which way we break. In this case, we're breaking higher. Now, anytime you have a gap like this, the next day, I would argue, is super important, because now that we've gapped up to around 370 or so, do you see additional buyers coming in tomorrow, coming in Friday, coming in early next week, still excited to own CRM at a big premium relative to where it was a couple days ago, a couple months ago? If so, the price is going to keep going up. If you see this gap followed by selling, that will tell you the opposite. That would tell you that investors are cashing out. You probably want to get out of the way and wait to see where it sort of stabilizes. But I would say at a surface level, just based on that move, pretty encouraging follow through in technology. Sticking with that sector, we have Synopsys, another earnings name, actually reporting, I think, after the close today, if I remember right. Is that true? Yeah, after the close today, Synopsys. But for now, gapping higher today, up about 3%. That takes us out of this range, takes us above the 200-day. And after pulling back and testing the 200-day about a week ago, we now see additional momentum to the upside. I think that clears the way, at least for a retest, of course, of the July peak and potentially further upside. Let's wait to see how this uptrend continues. But overall, I'm impressed by the price and relative strength breakout. The RSI is not even overbought yet, which suggests that there might be still more upside to be had. Not all earnings are great. And I would say Campbell's Soup Company and Consumer Staples, one of those examples of a disappointing earnings chart. The stock gapped lower about 6.25%, took us back to the November low. And that's kind of a concern because, mid-late November, this is a stock that's actually breaking back above the 200-day moving average, testing the 50-day. It's sort of like maybe this is going to start to work again. However, look at how we tested the 50-day moving average. I can't zoom in too well here, but this is basically a bearish engulfing pattern as we test a downward sloping moving average. That is a not good look from a technical perspective, right? A bearish candle pattern as we test resistance. That literally suggests that traders are selling that strength and betting on another leg lower. As of yesterday, we were down to the 200-day moving average. Now we're a lot below it. Question is, do we hold this support through the remainder of this week? So I would be keen to see if that happens. But if we break below these current levels, that basically just confirms that the downtrend still very much in place. Final chart here in consumer staples, Kroger, which is reporting tomorrow on December 5th, I think after the close, but don't quote me on that one. This has been one of the more impressive charts, I would say, in consumer staples. One of the more improving names, continuing to show strength here over the last couple months, making a clear pattern of higher highs and higher lows. Excuse me. If you didn't know this was a grocery store company, you might think it a software name or a technology stock based on this nice uptrend in the fourth quarter. Question now for earnings is, do we sustain this uptrend, right? If we get some downside gap, do we hold the recent swing low around 57? Do we hold the 50-day moving average? Overall, earnings could be key right here. I don't really have an opinion on earnings, but I would say from a technical perspective, the setup is pretty good going into an earnings release. Positive earnings tomorrow could really set the stage for the next big gain for Kroger. All right, I'll take a question or two before we wrap the live stream. I appreciate your feedback on the kickoff time. We're going with a 5 p.m. Eastern kickoff. I'm enjoying it because it actually allows me to have a lunch, which I have not had for about 5 years. I haven't had a decent lunch on a weekday because I'm always like scrambling, trying to get ready for the show. A 2 p.m. Pacific kickoff is way better. And so don't be surprised if we stick with this timing just because of that. Let's see. NZSEA, I won't try to pronounce that, but on YouTube, you asked, hi, Dave, what's your personal favorite combo weekly and daily, or monthly and weekly? I'm guessing you're talking about just charts in general, time frames. Daily and weekly are kind of my go-to. And if you want to know what charts I look at the most, these are the little kind of quick, quick buttons that I have set up on stock charts. These are the ones that I use the most, and it's pretty much in order from most used to least used, I would guess. It's probably right. So the 2-year daily chart is my go-to. If you ask me to evaluate Kroger, I would start there, right? I would start with the 2-year daily chart, and then I immediately go to the weekly chart because I want to understand, the current environment and how we're evolving versus some of the longer term history. And I like analyzing that main time frame, and then I'll go longer term, or I might go shorter term to the 1-year chart just to zoom in a little bit, zoom out a little bit, and sort of make a better assessment. So for me, daily and weekly are most important. Now, with my investment horizon, usually looking out a month or two on average, that's about right for me. If I was a longer term, looking out years and years for my positions, I would be using a lot more monthly charts because those give you a better sense of the big picture movements. And I do use monthly charts occasionally, but for me and the timeframes that are more interesting to me, I'm basically looking at that 1 or 2 month period, and then I'll look at the tactical movements, the swing trades between them, just to see if it's a good tactical opportunity to add or subtract from a position. So the daily and weekly combo is the main one that I pay attention to. Savalai, I believe, asking on YouTube, thanks, Dave. Which divergence is more important, price and volume diverging or other indicators diverging like price and MACD and RSI? That's a tough question. That's one of those asking to pick my favorite child. I mean, I love them all, right? I love them both. Both my kids are awesome, and I love them. I don't have a favorite, and I would never say that I do. And so it's hard to sort of answer that. Having said that, I do think that with technical indicators, you want to have a priority to it, right? So I have a checklist of things that I follow that I would use to evaluate a potential trade at any point. And for me, I would say, if you're asking me particularly about price and volume diverging or price and momentum is much more important to me because volume in general over my career has become less and less important to me. I would say that I do look at volume using indicators like Chaikin money flow and on balance volume. If you think of that as volume, certainly interesting. But for me, price is what's most important, and momentum is just a different way of describing and analyzing price action and just how a stock is moving from point A to point B. So for me, price versus RSI is probably the most important divergence that would stand out to me. Other divergences with other indicators, including volume, for me would be further down the priority list. Folks, that's it. I want to thank you so much for joining me here on Chart This, and every trading day after the close, again, here at 5 p.m. Eastern, we're doing our live market recap. I appreciate some of the thoughtful questions we've received here in recent episodes. Really great to engage with all of you, see what you're asking about. Really helps me to think about how to shape the content in shows to come. Don't forget the latest episode of our podcast, as I mentioned, just dropped earlier today on our YouTube channel. We're in the process of adding it to other podcast platforms like Spotify and Apple. So coming soon, stay tuned for that. And that's it for today. For Market Misbehavior, I'm Dave Keller. Remember, it's always a good time to own good charts. Have a good night.